Welcome to the Jay Tyner Show, where we discuss all things wealth management and retirement planning. And as always, the goal of our team here at Semmax Financial Group is to help you focus more on your life and less on your money. Now, as a reminder, check with your current advisor, planner, CPA, and read our disclosure in the video description below. Subscribe to this channel if you want to stay up to date on all of our new content. And by the way, if you have questions or need a 15-minute free consultation, please visit semmax.com or call 336-856-0080.
Hello and welcome. My name is Matt Landon. I'm joined by Jordan Shinsky, and today we're going to talk a little bit about inflation. Now, when people think about inflation, there's a lot of different things to come to mind. Basically, it's things cost more than they used to. It is more dollars chasing too few goods and services, but that's kind of a technical definition. Why don't you give us a little bit of a real feel of inflation? What does this mean? How does it work?
Sure. Think about going to the grocery store, okay? Nowadays, we may be spending as much as $250, $275 a week in our groceries for a typical family of four, but just a few years ago, it may have only been $100 or $125. That's the idea of inflation. It hits our pocketbook more than the numbers that we see on television or anything else for that matter. When we go places and we're buying goods and services, it's impacting us. It's costing us more today than it did yesterday. Absolutely. That's the idea of inflation.
Absolutely. And so you feel that it's a principle that we inherently understand. We can all look back and go, well, what did it cost when I was in high school?
Yep.
Right? If you actually look, so as of recording this, it's 2023. If you go back 100 years and go back to 1923, $1 then, in order to get an equivalent amount of goods today, you would spend almost $18. It would be $17.95. Mm-hmm. That is almost an 18 times more expensive than it was.
Yep.
That's wild. That's the power of inflation. So when we look at it, I think it's important to break it down into two areas. How does it affect you now? How does it affect you in the future? And what do we need to do on both sides? So on the immediate side, there's a lot of different implications of inflation. Mm-hmm. You mentioned one of them at the grocery store.
Right.
But on the financial piece, speaking not from a personal budget standpoint, but from a portfolio standpoint, what about that? What do people need to be talking or looking at?
So obviously with the higher rate of inflation, if we're going to keep up with that pace, we have to have a better rate of return. So we have to look at our portfolios in understanding what are we trying to keep pace with the growth? Are we trying to outpace, the inflation, the growth of the dollar? So we have to take a look at that when we're understanding the short-term nature of what inflation is doing on our money.
Absolutely. Mm-hmm. And so there's different positions and different things you want to consider. Typically, the stock market has handled inflation better because a stock price is simply what people are willing to pay for it. Well, as inflation drives things up, it drives stock prices up. Mm-hmm. That's a simplification. We can get into stock prices and how that happens in a different episode, but also rising interest rates. So the Fed are trying to currently get inflation under control. Well, they've done that by raising interest rates and now maintaining them at a high place. That has a direct impact on bond portfolios. Mm-hmm. As that happens, you can expect your returns to differ. And so that's the kind of thing that you look at it and you say, okay, do we just stay the course? Do we need to make adjustments? So if I'm looking at this as an investor, what would my main takeaway be from, okay, inflation's happening, what do I need to do right now?
Well, you got to be talking to your financial advisor and understanding what is the best position for your investment strategies. For instance, you had mentioned rising interest rates.
Right.
3 years ago, when we were talking to clients about interest rate returns, cash, money market CDs, we weren't really having that conversation because there was no return there. But now when you're looking at it, again, it's 2023, we're seeing CD rates at 5.5%, money markets at the same, T-bills and things of that nature that have a better rate of return. So now we're repositioning to take advantage of that. That's a short-term strategy, but it needs to be timed when the markets are right.
Right.
When interest rates come back down again and the inflation is no longer an issue, we may be repositioning again into a different strategy.
And that ties into that inflation-adjusted rate of return you were talking about a moment ago.
Right.
Because if inflation's still running at 5% and my CD's paying me 5%, in my mind, that kind of feels like treading water.
Yeah.
And sometimes treading water is not necessarily a bad thing. But at the same time, maybe we're trying to get to a goal. Maybe we need to start swimming forward. Mm-hmm. And so that's where I think you hit the nail on the head, speaking of talking to your advisor. That's going to be key. Now that's how you can make adjustments today, and we're constantly making adjustments to what's going on in the markets, whether it's rising interest rate, whether it's inflation, whether it's volatility, domestic or abroad. But what's the long-term implications? Because using that 100-year example, inflation it seems here to stay.
Yeah.
And I believe the Fed wants a certain amount of inflation because that's a sign of a healthy economy. So moving forward, what's the implications? What's the planning that needs to go into place here?
Yeah. So,
or should we do any planning?
good question. First and foremost, to get some benchmarks and understanding, yes, you're right. They want to have a healthy minimal inflationary rate. The Fed target right now is about 2.5% of where they want it to be. Historically, over the last 50 years, it's been on average 3.8% a year. Now, of course, there's an ebb and flow. We're having a conversation with clients a lot about it because a year ago, we were seeing 8-9% inflation. Now, it's come down from there, but it's still not to their target yet. The implication of what this has on investment planning, retirement planning in the future is that I want to retire today. I need a financial demand of, let's say, $50,000 a year.
Right.
But in 20 years, 30 years down the road, is $50,000 going to satisfy my financial demand at that time? Probably not. Inflation is going to cause things to become more value. I have to pay more to get them, so I'm going to need more money from my portfolio or from my whatever investment strategies or part-time work or whatever that may be. So we have to be able to build inflation into a retirement plan, taking into account the potentiality of 20, 30, 40 years down the road.
I think you're completely correct there. So with that said, if you have questions around inflation, be it in the short term and how your portfolio is positioned, or in the longer term, how are we planning for the future? How are we addressing inflation moving forward? These are both completely valid concerns. Don't hesitate to reach out to our firm. We'd be glad to assist. On behalf of Jordan, the rest of the Semmax staff, and myself, Matt Landon, we hope you have a wonderful day, and thanks for watching.